Hello all and welcome. This is Camilo. We are going live at around 8:30. Apologies, we are starting this late. Kenya Power decided to do that day today. And we are still on course. We tried our best within the limited time and gap. So the session is about conducting due diligence on money market funds. And it would make sense to talk about money market funds, considering that majority of Kenyans are depending on money market funds as the emergency funds. So it would make sense to talk about money market funds and try to decipher what it is and how best individuals can take advantage of it. So let's go direct to the presentation we prepared here, which will be presented by myself, that is Wakamiro. And most of those who have been to this channel or have followed me on social media might be knowing me, but for the newcomers, let me introduce myself. I'm Wakamiro. I comment on the economy, matters, financial and money markets, and this is to help individuals make better economic decisions. I have 8 years experience in the finance field. I've worked as an accountant for a couple of years. I took my undergraduate in entrepreneurship and also took certified public accountant training. So let's just be direct and we go to introduction. And for introduction, we'll start by talking about emergency funds. And we want to look what emergency funds are and how best individuals can utilize emergency funds to secure their financial future. And we'll be looking at why would anyone need an emergency fund. We'll be talking on how to build an emergency fund. Where do you keep these funds now that you have set an emergency fund in place? Where do you keep the money? Also, we'll look at the features of an ideal emergency fund and the options that one has. How can you save this emergency fund? This will this will be the introduction before we get to talk about money market funds. And rainy days are inevitable to happen. People lose jobs, people get redundancy, business failure, business decline, people losing their source of livelihood. And having an emergency fund in place then makes sense to have an umbrella for the rainy days. And why would anyone need an emergency fund? Majority of us are sitting on the edge when it comes to finances. If an individual loses the job or source of livelihood, maybe a business, if a business fails, this individual doesn't know how they would make through, how they would pay rent or pay bills, And having an emergency fund in place acts as a cushion when you lose your source of livelihood. You can actually be able to utilize these for the rainy days. Um, the second benefit on why one would need an emergency fund. Um, when I have money in my bank account and with my debit card, it is really easy to spend that money. Now with the digital banking, mobile banking platforms, it's very easy to spend that money which is in a bank account or having money cash. It will be very easy to spend that money. Though it would, when you have an emergency fund in place which has been set aside, you won't be going for that money. You won't utilize, you won't use that cash. You won't spend that money. When you don't have money within your reach, you will tend to live within the limit. When emergencies happen, people tend to rush for emergency loans, and which come at a cost. They tend to be a little bit expensive in comparison to the usual, the conventional loans. So it would make sense to have something set aside which one can utilize when things get big. So how do does one build an emergency fund? Conventionally, you should be having an emergency fund that will get around 3 to 6 months of your living expenses. And though this rule would vary in respect to different individuals' financial situations, there are some people who are guaranteed their career is guarantees them perpetuity, continuity to the future. So for this kind of individual, they would probably need not longer, not plan for a shorter period than another person. But for an individual who is in a volatile industry, which getting a job is a hard task, then it would make sense to be able to cater for a couple of months when this person will be looking around for a source of income. So, and we would have to talk about emergency funds post-pandemic, COVID-19 pandemic. People lost jobs, people lost their livelihoods, and not for a month or two. It was a prolonged pandemic for some. And then it makes sense to have something that will cater for an individual living expenses when one loses their job or loses their source of livelihood. So when building an emergency fund, the best strategy for low income earners, middle income earners is building it gradually. You have to have a target. Maybe say, for example, an individual said, I need an emergency fund of 250,000. It cannot be done within a day. So it would make sense to build this emergency fund gradually so that within given year or two, you'll have reached where you wanted to or you have achieved your goal. So when you are building your emergency fund, you need to determine the value of your critical expenses, which will not be limited to the list, but rent should be factored in, food, healthcare, utility bills, and debt repayment. If you have a loan which you are servicing every month, you should factor in these when you are building up your emergency fund. So how big or small your emergency fund is will be informed by the size of your critical expenses. Um, then you need to determine whether you are one of those people I was discussing working in volatile areas, or they are not assured of keeping their jobs in the coming year. So the more volatile your industry is or your situation is, then you would have to plan for more months. Then from there, we have already said you need to grow your emergency fund gradually. And here's just a presentation on how an individual goes, someone who is contributing maybe 500 per month towards getting an emergency fund. So if you invest this money, if your emergency fund is an interest bearing emergency kitty, it will earn you something neutral. We'll be looking at the ideal emergency fund on the factors that it should, all the boxes it should tick for it to be considered ideal. So our individual here, maybe a security guard, is able to set aside 5,000 shillings per month towards an emergency fund. And by December, this individual has around 60,000. The rest can be considered as interest. So if this individual had a goal of having an emergency fund whose size is around 120,000, then they would have to do this for 2 years. When you have said you need to set aside 250,000 for your emergency fund, where do you save this money, or where do you keep this money? So this is what we'll be considering now, and we will be looking at the features of an ideal emergency fund. Number one, it should be liquid. This money is set aside for emergency purposes. So you need to access your funds within a short notice. So the ease of getting your money back should be at most for 2 or 3 days. Then in the wake of raging inflation everywhere, here locally and outside, you don't want to keep 250 in an account and receive it back as 250. So an ideal emergency fund should be interest earning. To cater for inflation, you need your emergency fund to be interest earning, and then this money will be asked for within short notice. Things happen, so you need your emergency fund kitty to be low risk, to be secure, so that you don't lose your money. The options you have when you're creating your emergency fund, you have an option for insurance, you have an option for fixed deposit account at the bank, and you also have an option for a money market fund, which is the subject of our discussion today. We are just tackling the introduction on how you would do your emergency fund, which I believe for so many people would make sense to be able to look at their financial situation and agree that they need an emergency fund. I started by saying rainy days will inevitably happen. So let's talk about money market funds in Kenya. This was our subject for discussion of today. And what we call money market funds is one of the most popular funds down the collective investment schemes, or what we call unit trusts here in Kenya. And what they are pools of funds where a fund manager pulls funds from different investors And these funds are entrusted on a professional fund manager who invests these funds in interest earning securities. There are regulations that govern all this process of raising funds and investing these funds and making sure that the investors get value on their money. And money market funds or collective investment schemes, which is the umbrella. This whole business is regulated by the Capital Markets Authority, and so you'll find a company licensed to conduct collective investment scheme business is licensed by the Capital Markets Authority. Uh, what is happening is, with the name of making more people participate in the capital markets. So let's look at a structure of collective investment schemes as it is in the country, in Kenya. And here we have approved collective investment schemes in Kenya. There are 29 approved collective investment schemes, though only 19 are active. Then all these collective investment schemes, there are around 114 funds under them. So you'll find that company A is licensed to conduct the business of collective investment scheme, and under the company there are a couple of funds which we'll be looking at. And what is popular is the money market fund. We have around 29. Then there is the fixed income funds. They are around 24. There are equity funds. They are around 18. And other forms of funds with totaling to around 43. So money market fund, as I started by saying, is the most popular under the collective investment scheme. So you have decided that you want to set aside some emergency fund, and you have explored the best option to be a money market fund. This is where you want to invest your money. And money market fund fulfills the features that I have illustrated of an ideal money market fund, an emergency fund. But there is ease of getting your money back. They are very liquid. You give a notice of 2 or 3 days and receive back your money. Then there is a window of growing your fund gradually. They have money market funds accepting as low as 1,000 deposits, depending on your income generating capabilities. You can go for weekly or monthly. They'll accept as low as 1,000. And then the other feature I had said, and which the money market fund fits in well, is interest earning. Money market funds pay above average interest. You will earn something a little bit extra than what you would earn on a fixed deposit account. The good thing with money market fund is your savings or your interest earnings your interest earning on your savings, they are plowed back and you can benefit from compounding interest. So when you have agreed that you want to go the money market fund way, then there are a couple of them. We have seen that there are around 24 money market funds in the country. Then it would make you would have to decide which company to go for, and making this decision is not based on what I call as a market as trying to win you to invest in a certain investment option without the investor doing some background checks so that you can be sure or you can be guaranteed that your funds are safe. despite there being regulations that the industry is regulated, regulations, these laws made by human, they tend not to cover everything, and then it will make sense to watch your back as an investor. It is your money. And how to conduct that due diligence, that was the purpose of this live session. You want to first confirm that the money market fund you are considering is registered and also adheres to the regulations as pertaining to that fund. You also want to determine whether the fund that you are going for is regulated or unregulated. In the country, we have two types of funds. There are regulated and unregulated funds, which I'll be explaining as per the regulations. You also want to look at the fund prospectus, and this is basically where you find everything in regards to the art fund. You'll be told of the past performance. You'll get issues to do with asset allocation. You'll get in the fund prospectus, they tell you whether the fund is regulated by who, the interest earning, the charges to the account. All that information can be found in the fund prospectus. Then we'll be looking at an asset allocation schedule, which can be generated from the prospectus. It can be there, or you can generate from there, on the financial statements of the individual fund. We'll also be looking at the other thing you would look at is the past performance. Now, when you have the financial statements of this fund, you can be able to look at the past performance in respect to growth of the assets under management, or what we refer to AUM. You'll also want to look at the market share. It tells you a lot of the trust that people have. That will be important to look at. Also, you want to ask yourself, what is in the news? What is in the news? What are people or individuals saying concerning the specific fund? Whatever is in the news, in the mainstream media, social media, you also want to hear of reviews of people who have used the specific fund. So, the number one question was, is this fund duly registered, and is it adhering to regulations? For you as an investor, every other time you choose an asset class to invest in, we talk about investing in shares, we talk about investing in bonds, either government securities or corporate bonds, we talk about investing in real estate, or mutual funds or unit trusts, as what we are covering today. Every other time you are picking an asset class to invest in, what you want to do as a first order of business is briefing yourself on the regulations that govern the industry. If things went haywire, what is your lead? You want to know the regulations so that you are going into something that you know how to do, you know how it works. And number one, as we started, we said the collective investment schemes are licensed by the Capital Markets Authority, and the Capital Markets Authority in their website, they will always publish a list of all licensed collective investment schemes and their funds under them. So this will be your first point of call to check whether this money market fund that you are considering is listed by the Capital Markets Authority in the website. Then, as per regulations, money market funds are supposed to make reportings, financial statements, and other disclosures. And these reportings and disclosures should be published in the website, and also a copy should be available in the registered office. So if you want to see the fund that you are thinking about on how it is performing, then it will make sense checking the website for the financial statements or visiting the registered office and be able to scrutinize these reporting and disclosures. Let's talk about something important, and we'll talk about this with a sad memory of what happened to some investors in one of the money market funds in Kenya. So there is a rule or a guideline which compels a fund manager not to allocate more than 20% in a certain asset class. But what happened is a fund manager went ahead to invest around 23% of the AUM, assets under management, in the one of the corporate bonds which was issued, though the issuer went under. And we'll be talking about corporate bonds in coming sessions. But a key takeaway to note here is these corporate bonds comes with some terms. Majority of them, or a couple of them, depending on the terms, will not be secured. So what had happened is a fund manager invested investors' funds in a certain fund, and at the end of the day, this issuer of these bonds went under, and the bonds were not secured, so the individuals could not get their money back. And there's a recent guidance which was issued on asset allocation, and that is guidance 26A, which says the composition of a money market fund require that funds invest only in interest earning money market instruments which have maximum weighted average tenure of 13 months. Be they commercial paper, be they treasury bills, be government securities, called deposit, certificate of deposit, and any other like instrument as specified by the CBK from time to time. So this is another regulation which compels fund managers of money market funds to invest in securities that has a tenure of not more than 13 months. We are talking about 1 year and a couple of months. And we'll do an example here of one of the collective investment schemes is the NCBA Unit Trust. And it they had the NCBA Money Market Fund. And after these guidelines were issued, NCBA drew a circular which it had sent to its unit holders. They explained to the unit holders the challenges in adhering to guidance 2 of 6 of the guidance for collective investment schemes on valuation, investment, performance measurement, reporting, and other related matters. So in these guidelines, the regulator says that you can only invest in securities that have a tenure period of 1 year and 1 month. So NCBA felt they could not keep up with this, because they had a good explanation of adhering to this regulation would lock out them from securities such as government bonds, some which have a tenure of more than 1 year. So what the fund manager opted is to write to the Capital Markets Authority with the intention of changing the name we changed from NCBA money market fund to NCBA fixed income fund. So when you are investing in these investment schemes, you would have to also keep yourself updated and also asking yourself questions. What does this change mean to me? So it is good, as I said, if you are going for an asset class, kindly make sure you get to understand the regulations governing that industry or that asset class. Let's look at another factor you can consider before you invest in a money market fund or any other fund under the collective investment scheme. What you want to ask yourself is whether this fund is regulated or unregulated. If the fund is regulated, CMA is watching, has these regulations that the fund manager should adhere to, or they lose their license. But if you go for an unregulated fund, you are on your own, so to say. You are on your own, and the Capital Markets Authority would do nothing in case things went south. So here in Kenya, we always get offerings for regulated and also unregulated investments. And the regulated ones are controlled by the Capital Markets Authority. What the Capital Markets Authority is doing is protecting investors' interests. There is a whole framework of regulations that govern these capital markets business of pooling funds, investing in these funds. And what CMA is looking to do is regulating public issues of shares. Someone telling you invest here, buy some units here. They want to regulate that so that it is done in a formal manner where investors are protected. By the time of listing, the Capital Markets Authority ensures that the fund manager meets the requirements that it has set on place. And also the law prohibits anyone from dealing with the investment or calling people to invest in a certain investment product without a license from the CMA. So unregulated market products, they are not under supervision of or control of any regulatory body. And the Capital Market Securities Public Offers Listing and Disclosures Regulation of 2002. That is the main law governing the issuing of securities to the public. It is not applicable to these what we call private offers. And they are closed shop. And actually, majority of people come to know about private offers through referrals or through WhatsApp messages and all these other. You go online and find someone tell you here is an investment opportunities where people are purchasing maybe shares in a certain hotel or whatever, those kind of things. But they are private offers which the law doesn't cover or cater for. Though it doesn't ban, but it restricts these private offers to a select group of investors in the assumption that the investors who are being asked to invest in these private offers, they already know. Though there is a gap, because when I receive a message on WhatsApp about a certain investment opportunity, I wouldn't know whether it is regulated or unregulated. And then this is where it makes sense to, if you hear this kind of investment opportunity, be fast to check with maybe the Capital Market Authority or someone conversant with those areas, you can always ask. This is where financial advisors come in handy to ask whether your money is safe or not. Private offers, they are prohibited from being publicly advertised, and or you don't want to give a private offer to a larger public that is unknowing. They don't know how this private offer is working. So investors of a private offer, they are assumed to know. So when you are going for an unregulated fund, you are assumed to know that all the risks that are associated with this unregulated fund, and you are doing it voluntarily. And as I've said, the victims fall for fraud because this information will be passed through social media and everything. So to tell whether a fund, a money market fund, or a fund that a collective investment scheme is regulated, I've said you ask for the company that is offering an investment opportunity, ask them for a fund fact sheet. And here is an example. And they are saying this is one of the fund managers saying the asset class that will be invested by this fund. They're also talking about taxation. Then there is what I'm interested on checking, which is to say, is this money market fund regulated? And for this, they are saying yes by the Capital Market Authority. So suitability, it is low risk appetite, high to low liquid need. So if you are not your risk appetite is not high, then this would make sense to go for this. So basically, this is a caption of a fund fact sheet. There is so much information. I just picked this to be able to show that money market fund sheet should be able to tell you whether it is regulated or unregulated. So the other point, as I said, we were going to pick you are going to ask for the fund fact sheet, and here is an example of the CIC money market fund. Using these examples, there are so many